So when we talk about investing, we often compare ourselves to market returns. But what is really the market? In many ways, most people define the market as the S&P 500 returns. Now, you might look at European markets, which will be a different index and so on, but globally, you always usually benchmark versus the S&P 500, the 500 biggest companies in the US, as being market returns. And personally, I've been investing in that market through my ETF of choice. And yeah, well, been very happy with it and benefited from some nice gains over the time. And I thought it would be interesting to kind of look at it, whether I still think that the S&P 500 might be one of the better choices for many people, from beginners to more advanced people who really want to have a passive sort of way of investing. Because obviously there's so many different ways how you can invest your money: individual shares, ETFs, crypto, real estate. So I really want to dive into the S&P 500, see how it performs, and why I'm personally still bullish on it long term, and why I'll be continuing to dollar cost average into it. Now, of course, I assume you have an idea of what the S&P 500 is. If you don't, I link a video down in the description below, which you can check out after this video, which kind of explains you how it's composed of, what it is. Essentially, it's an index. You can't directly invest into the S&P 500, but you can invest in an ETF that follows that index. So the S&P 500 is an index of those companies, and you choose an ETF. There are many different ETFs based on the S&P 500 that you can choose from an ETF provider, such as BlackRock, Vanguard, State Street, many other ETF providers. And through them, you can actually invest and benefit from the gains of the S&P over time. And talking about gains, well, you see here the average annual returns over a 10-year period is actually at 12.7%, which is really quite surprising. And actually, even for me, a nice refresher, because we usually tend to say that over a 30-year period, it returns anywhere from 8 to 10%. Obviously, it depends on how we measure things and so forth, but generally, imagine anywhere from 8 to 10% over a 30-year period. Now, over 10 years, as you saw the number, it's even higher. That's because the last few years have really been a bull market, so to say, especially with tech and AI really having a major drive and boost to the price appreciation of the S&P 500. And obviously, with more and more tech companies doing stronger, that will also impact the composition of the companies inside the S&P 500. I'll come to this in a moment, but that also changed. The more strong tech and AI companies we have, the more they will be dominating inside the S&P 500. And of course, the appeal of buying an ETF as such is that you don't have to stock pick individually, follow all those companies, what they're doing, but with one single buy into the S&P, you basically owning a slice of the 500 largest US-based companies. And they are de facto also global companies, many of them, right? Because let's be honest, Coca-Cola, Apple, all of them are operating on a global scale. McDonald's, pretty much most of the top companies in there are by default global companies. They happen to be from the US, but they're really operating on a global scale. So if they are performing well in Asia and the Middle East, well, guess what? That will also reflect on their results back home, right? So that's why I'm generally quite happy having such exposure on the US, because I do know that they're also operating on such a global scale. Now, it's very interesting if we break down the sectors. You can see here, right now, majority of it is information technology, which I like. And let's be honest, whether you like it or not, there's no denying that tech is going to be the future, right? I don't think we're going to see less tech in the future. It's probably only going to get more. Then you have financials also. We have healthcare over here, then a bit of consumer discretionary and some communication services, as well as industries and others. But in the past, if you go back 20, 30 years, it was much different, right? You would have way more industrials in there, consumer discretionary. All these players were much bigger and had a much higher weighting. So as I said, as those companies in IT, in finance, starting to get bigger and bigger, their weighting inside the S&P 500 is also going to be bigger because it is weighted. So the bigger a company's market cap is, the more valuable a company is basically, the higher their weighting. I'll show you that in a second. And here we see some of the top holdings, obviously names you're all going to be familiar with. I have no doubt about it. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Berkshire Hathaway, Eli Lilly, Broadcom, and JP Morgan Chase. Those do change over time. As one gets more valuable, one gets less valuable. Sometimes there's also Tesla in the top 10. So this is dynamic. If I go back 30 years, I believe there was even Coca-Cola in the top 10. So that's a cool thing. These things do change over time. But you don't have to worry about it, right? If tomorrow another huge company comes along, let's say Palantir continues to grow like crazy and one day is inside the top 10, well then you as an S&P 500 shareholder will equally benefit from the strong performance of Palantir or any other company for that matter. And you don't have to think, should I buy it, should I not buy it? That's the beauty of having an ETF that's based on market capitalization like we have in the case of the S&P 500. Now, if I jump over to justetf.com, a free great resource that you can use, I actually go into one of the ETFs. In fact, this is the very one that I'm buying myself, but this is not financial advice or buying recommendation. I just buy it because it has the lowest expense ratio of 0.03%, which makes it the cheapest S&P 500 ETF out there, because the higher the expense ratio is, the lesser your returns, right? You don't actually pay it, but it comes out of your returns. Some of the same have an expense ratio of 0.09, for example, and that obviously makes a difference over the years. Don't believe me? Jump over to Match My Broker. You can find it down in the description below. And I have a ETF fee calculator over here. So you plug in some numbers, you can change the currency how you wish. Maybe you have initial investment already, but let's assume you're starting with zero. Annual investment, 1,000 per month, which might be feasible for you depending on your life situation. It's 12,000 a year. Annual investment increase, let's say you get a salary increase. So in the future, hopefully you'll be able to invest more. So let's say a 5% annual increase on that. Expected return, as I said, anywhere from 8 to 10%. Last 10 years over 12%. So let's go conservative with 9%. And then we have a time period of 30 years. You can change that as well if you want. And then I put my ETF that I'm paying right now at 0.03%. And then we have other S&P 500 ETFs at 0.09%, which seems pretty small when you think about it, right? Well, let me show you what a difference it makes. After 30 years, you would be saving almost 30,000 euros just by going with an ETF, slightly lower fees, which really you don't think makes a huge difference. But guess what? Over the time, it really does. You see here in the beginning, it's actually not that much, but as the year goes by and your portfolio grows, that difference will also grow from the percentage. So that's just something to keep in mind. And that's why I'm sticking with the cheapest one right now that I can find. It's also physically replicating, means they actually buy the underlying assets. Mine is distributing, but you can also choose accumulating. It's really up to you. It just means that every 3 months, the dividends that I'm receiving, and I'll come to this in a second, they're not really high, but still, I like the feeling of getting paid. Plus, my account is based in the UAE, so I don't pay dividend tax on that, only US withholding tax. So for me, it actually makes sense to receive the money and then automatically reinvest. But hopefully one day, as the portfolio continues to grow, I can maybe even live off these dividends, not fully, but at least use it for some things to pay, my living expenses, whatever. And of course, you always want to make sure that you have a big fund size. Now here, it's 13 billion, which seems pretty decent, and they have been around for over 13 years. So yeah, that's also good to see. And you can see here how many holdings they have, just slightly over 500, as the S&P 500 would imply. So then we go to holdings, and you can see here pretty much the same names. Here it's Tesla. So as I said, obviously it's very dynamic, right? If Tesla increases in value, and previously we've seen JP Morgan drops off, so that's very dynamic. But you can see also that Apple, their weighting inside the top 10 is much higher than the one of Tesla, because the value of Apple is significantly higher than the one of Tesla. The market capitalization, basically the number of shares times the share price, is the market capitalization. And here right now, Apple, is at the top. And then basically you see here the top 10 alone out of 500 companies, the top 10 altogether make up 33%. So that's a huge concentration. Means that the biggest company is so much more valuable than the 500th company, right? So even if the 500 company doubles in value, in the grand scheme of things, it won't really move the overall price of the S&P 500. So that's something to keep in mind. I'm fine with it, but you may not. There's also equal weighted S&P 500. So if you prefer to have all of them the same weighting, there is such ETFs as well. But I like to really double down on the winners. And if the 500 company continues to increase and moves to the top here, I will still benefit from it, right? So I think it's actually a pretty smart system to have. See here, the countries obviously mostly in the US. Ireland is just because they register over there in Ireland to be UCITS compliant. Because one thing to keep in mind, unless you're American, you can't actually buy or shouldn't buy US-based ETFs. There are some rules about this. And also taxation-wise, it's actually not that good for you, because then you would be facing US estate tax. If you were to pass away one day and it inherits to your family or whatever, they would pay a hefty tax on your holdings. So you want to avoid that. So better go with UCITS ETFs, which are mostly domiciled in Ireland. And that's perfect for anyone outside the US. Then continuing on the slides over here, obviously it has strong track record, and especially also if you compare it to other ETFs, such as all-world ETFs. So these are basically indices that have a global diversification. For example, Vanguard FTSE All World is a really popular one. You can see, of course, the expense ratio is also higher, but you see over here, you have 3,000, almost 600 different companies in here from all over the world. So you're much more diversified, which is, in a one hand side, obviously nice, right? When I go to the holdings, you can see over here, you have now United States still makes up almost 60%. It does have a strong weighting because naturally those companies are so valuable. But then you have also Japan, UK, China, Switzerland, Canada, Germany. So much more diversified amongst the different sectors, some diversification. But again, also you see here top 10, once again, because the US is so strongly dominating, most of them are US based. You do have Taiwan Semiconductors, and obviously, top 20, top 30, you would have some companies from other countries as well. So that can be a great option as well to invest your money in. And I know a lot of people like that, to have this diversification, and I'm all for it, right? I'm not saying no. Just personally, for me, I look at performance, and I do understand that historic performance is not guaranteed for future returns. But when I look at the facts, what happened in the past, well, then we got to be honest to ourselves, right? When I look at Max, that's basically all the way from, around 2012, 13 years ago. Well, you see here, the Vanguard FTSE performance increased by 317%, which is still, respectable and amazing, right? Better than keeping your money at the bank, earning nothing basically. But if I compare to the S&P 500 ETF that I buy, it's almost doubled. Not quite, but 517% increase. That's a major, major difference over time, right? If I go back to 5 years, still, it outperformed by almost 20% more. 80% versus 100% returns. Again, obviously, you might feel better being diversified, and it's totally fine. Then go for it. I think it's still a great, great choice. I just prefer a lower expense ratio. As I said, 0.22%. I would understand if it has superior returns, but in this case, I don't actually have, at least historically. Maybe it will change in the future. Nobody knows. But in my eyes, yeah, that's another reason for me to stick with the S&P at this stage. Now, I did also want to mention the dividends. Now, you can see over here, the dividends is currently 1.12%. Really doesn't sound like a lot, does it? So in a year, I get a couple of €100 from that. Doesn't change my life, but of course, still a nice to have. And as soon as it arrives in my various brokers, I actually reinvest. But I want to show you how that little percentage still makes a difference to your return long term. So if I go over here on Seeking Alpha, you can actually see here the price return, which is purely the increase of share price over time of the S&P or the ETF that follows it over a 10-year period, is basically 193%. So that's the S&P itself, that's the ETF, pretty much the same. However, if I now factor in the dividends, which is basically the total return, and now go to 10-year period, now all of a sudden you see here it jumps from 193 to 250%. So that 1% dividend reinvested over time makes a major difference in the dividend returned to US investors. And that's why I'm a big fan of reinvesting your dividends. And if you don't want to be bothered with it, you might be better off going with an accumulating S&P 500 or any other ETF, so you don't have to worry about logging into your broker, reinvest the dividends. You might actually prefer an accumulating ETF, so it's all done for you. So basically, every time you're supposed to get a dividend, they just buy more ETF shares with that money for you. So that might be an even easier option for you. And let's talk about why I continue to be quite bullish about the S&P 500 long term. Now, first of all, US innovation leadership. Now, whether you like it or not, I'm not talking here politically. And yes, we had some ups and downs with the current president from the US, which is, going a little bit all over the show, like a roller coaster. You never know what happens. But I'm investing on a long-term time horizon. And I will probably see many other presidents in my time as an investor, but there is no denying that still the US leadership in innovation, AI, all these tech companies, which are mostly US driven, the only real competitor to them is China, which I find a little bit tricky to invest in because, in terms of transparency and various reasons, I used to live in China, so I have my reasons why I prefer the transparent system that I get with the US. And of course, the global reach, as I alluded to earlier, those companies are operating on a global scale. Apple, McDonald's, Nvidia, all of them are globally available companies that people need and use. So you're not just only investing in American companies operating locally. Quite the opposite. Simplicity in structure, it's really low cost, as I've shown you, compared to an all-world ETF. It's a major difference. Now jumping back into my ETF calculator, if I plug in the fees I would pay for the all-world ETF of 0.22%, well, guess what? Over 30 years, the difference would now be €90,000, which is not my money anymore, but it went to the ETF provider. So, I'm not really interested in that, right? Especially considering that my returns would also be lower than I would get potentially with my S&P. Again, it's not guaranteed, but just judging by historic returns. And of course, US dollar strength. Now, I know this is up for question. Some people may believe in that or not. I think even if the US dollar was to go one day, which may happen, we might have a US digital coin. It doesn't really matter. Ultimately, I'm not as such investing in the dollar, but in the underlying business. And whatever currency they'll be using to transact in the future, the underlying business, that's what's generating the revenue and the profits for the company and us, the shareholders, right? So right now, obviously, I'm investing in USD because I do think still is stronger than euros and many other currencies. But even if it does change in 20, 30 years to a stable coin, whatever it will be, I don't really care because we anyway is going to face that as global investors. But I know that the underlying business is strong enough. But let's also address a couple of concerns that I often hear from people. When people say it's too concentrated in tech, for example. Well, to that I say, yes, it has higher concentration than other ETFs. But as I said also at the beginning of the video, if you think the future is less tech than it is today, well, then maybe you should find a different ETF. I agree. But I'm quite the opposite, and I'm really doubling down. In fact, I'm also investing in the NASDAQ 100, which is even more tech in there. So I'm bullish on tech long term, and I'm actually happy to have that exposure. And that's why we've also seen the higher returns over the last 10 years versus the last 30 years because of the great gains we've seen in tech. Of course, we hear about all-time highs means it's a bubble, right? But then again, all-time highs will keep on happening. That's how stocks increase over 30, 50 years. I mean, the S&P 500 has been through 2 world wars even and still continues to grow, right? So it's always going to be a new all-time high. I mean, otherwise, who would want to be investing in that, right? The same way how money depreciates over time, the same way stocks and companies usually increase in value, right? I don't know too many places where the real estate is cheaper today than it was 30 years ago. It usually doesn't happen that way. And the same is true if you invest in fundamentally strong companies. That's the important part, right? Whether there's a bubble or not, yes, there will always be ups and downs, but the long-term price trajectory of the S&P, like many other ETFs, not only S&P, right? They're usually on the upward trend. So that's why I dollar cost average, because I don't know, is it a good price now? Will it drop tomorrow? Nobody knows. That's why I continue to dollar cost average every single week. You might do that every single month because nobody knows what the price will be in the future. And the last one, we spoke about it also. Shouldn't I just buy an all-world ETF? And absolutely, you can, right? There's nothing wrong with it. In fact, I think it's a great option to invest as well, to have maybe even more diversification if one day US was to drop a little bit and maybe it moves towards East with China and other countries picking up. Great, right? Absolutely nothing wrong with it. Then again, as I just shown you, historically at least, the performance just wasn't quite there. Plus, you're going to pay a little bit more on fees. So it's your choice, nothing wrong. But right now, I still think that the S&P is the stronger performance, at least for the coming years. If I was to see a major shift macroeconomically, really deeper forces that are going against my thesis I have about the US market, then yes, I might change my investing approach in the future. But right now, I just don't see it. And if you also want to invest in the S&P 500, it's actually pretty simple to do. A lot of people overcomplicate it, but it's actually extremely simple. First of all, you want to choose a low-cost broker. Now, there are many stockbrokers out there. Obviously, in my channel, I feature a lot of them. I personally use 3 right now. Most of all, Interactive Brokers, Trading 212, and eToro. All of them serve me different purposes, have different benefits, and I like to diversify. Same with my investments, also across my brokers. Even if one is down, I can still trade on another one. But choice is yours. You might just want to start off with one. In this case, I would probably recommend you Trading 212. It's super simple to use. Definitely use my link down in the description below. Or if you already signed up, use the code KAI inside the app and you get a free share valued up to 100 euros or pounds. So definitely something to take advantage of. And there you can buy ETFs and stocks totally commission free, which is awesome, right? So even if you invest with a little money, maybe you invest 50 euros a month, 100 euros a month, you don't want to end up paying 1-2 euros commission, right? That would definitely go out of your returns. If you have a larger amount, great, 1 euro doesn't really make a difference. But on 50 euros, 1 euro is very painful. So make sure you pay attention to commissions. That's why I said Trading 212 could be a great starting point. Then you obviously want to go ahead and select the right ETF that you want to invest in. Personally, as I've shown you, I picked the SPY5. The choice is yours, but if you want to pick the same, you can also choose it in different currencies because as I've shown you, I actually invest in US dollars in London. That's the one I pick over here, but you might want to invest in a European based in euros. You can invest in Paris, for example, in Italy, Germany, different stock exchanges, even Switzerland, in London, in pounds. So different options out there. Once again, on justetf.com, you can find that all the different symbols as well. And then just go over to your broker of choice, put in the symbol, and usually they have a number of those represented on the various platforms. Interactive Brokers for sure, that has probably one of the biggest offerings out there. And yeah, then you just go ahead and buy it one-off, or as I recommended, set up a DCA plan, dollar cost averaging, where you basically automate your buys over time, either weekly, monthly, whatever it is. You just make sure you have enough money in the broker, and then once it's set up, all the brokers I mentioned can do that automated trades. So you don't even have to think about it. You don't have to log in to your app or broker and do the buy. It will just be done automatically for you. And that's really the best way, right? The same how I always say, brushing your teeth. You don't put it on the to-do list. You just have it as a habit or routine. It's almost automated, right? The same with investing. If you have to think about it, it's been a long day. Now I need to log in and buy the stocks. Often you will end up not doing it. And that's when you miss out from those great compounding results I've just shown you. So make sure you really automate it as much as possible so it's totally hands-off. Because ultimately, the key is to stay consistent. When I've shown you 12.7% return over a 10-year period, that assumes that you were invested for the whole time. If you just, invest once in a while, maybe every few months a little bit, and then something else, your returns will be significantly less, right? And that will be more like market timing instead of what you should be doing, spending time in the market. Well, guys, there you have it. I hope you found this insightful. If you have any questions, pop them in the comments down below. Next up, check this video over here. As always, thanks for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.